What if I told you the silver market is quietly moving toward a point where demand could overwhelm supply, and most investors won't see it coming until prices explode? Right now, behind the scenes, something unusual is happening. The physical silver that actually matters in the market is not increasing. It's just moving around. And that creates a dangerous illusion of stability. Welcome to Gold Silver Scope, where we break down the real story behind gold and silver in simple and clear terms. If we look closely at the current silver market, one key pattern stands out. There are large deliveries happening, but the total inventory is not really growing. For the past few years, the amount of silver in major vaults has remained almost flat. This may sound normal, but it's actually very important. What it means is that silver is not being added to the system in a meaningful way. It is simply changing hands. One bank delivers to another, ownership shifts, but the metal stays in the same place. Imagine a pallet of silver bars sitting in a warehouse. Today, it belongs to one institution, tomorrow another. The label changes, but the silver doesn't move. This is how much of the market works. So when people see large delivery numbers, they assume supply is strong. But in reality, that silver is not increasing. It's just circulating inside the system. Now here's where things get interesting. What really matters is not how much silver is inside the system, but how much is leaving it. And recently, we've seen signs of silver flowing out of major vaults at a faster pace. This is a critical signal, because once silver leaves these systems, it becomes much harder to bring back. A large portion of this outflow appears to be heading toward Asia, especially major trading hubs and growing economies. These regions have strong physical demand, and once they take delivery, that silver often does not return to Western markets. This creates a slow but steady drain on available supply. At the same time, global demand for silver continues to rise. It is used not only as an investment, but also in industries like electronics, solar panels, and advanced technologies. This means silver is constantly being consumed, not just stored. And here is the key problem. Production and recycling are not keeping up with this demand. This imbalance doesn't always show up immediately in price. In fact, the market can stay stable for a while, giving the impression that everything is under control. But underneath the surface, pressure is building. We've already seen small signs of stress, like delays in delivery or temporary shortages in certain types of silver products. These are early warning signals. They don't mean the system is breaking today, but they show that the margin for error is getting smaller. If demand spikes suddenly, or if supply is disrupted even slightly, the market could struggle to keep up. And when that happens, prices don't move slowly. They adjust quickly and aggressively. Because in a physical market, if you can't meet demand, the only solution is a higher price to attract sellers. Right now, the silver market is in a delicate balance. It moves in cycles, sometimes tight, sometimes loose. But the long-term trend is clear. We are using more silver than we are producing. And sooner or later, that gap has to be filled. The real question is not if pressure will build, but when it will reach a breaking point. Now, while the long-term fundamentals of silver look very strong, the short-term behavior of the market can be confusing for many investors. Right now, instead of moving straight up, both gold and silver are showing signs of slowing down. This is something that surprises a lot of people, especially those expecting non-stop price increases. After a strong rally, markets often need time to cool down. In recent months, silver experienced a very sharp move upward. When prices rise too quickly, they often become overextended. This means the market has gone ahead of its natural pace, and a period of consolidation becomes necessary. This consolidation phase usually looks like sideways movement. Prices go up and down within a range but don't break out strongly in either direction. It can last for several weeks or even longer. For gold and silver, this kind of behavior is actually healthy. It allows the market to stabilize before the next major move. However, this phase can be frustrating. Many investors enter the market expecting quick profits. When prices stop moving or become unpredictable, they lose patience. These are often referred to as weak hands, people who exit the market too early because they expected immediate results. This process is important because it removes short-term traders and emotional investors from the market. Once that happens, the remaining investors tend to be more patient and committed. This creates a stronger foundation for the next upward move. Another interesting factor is how silver behaves during global uncertainty, such as economic instability or even war. Most people assume that precious metals always go up during crises. But in reality, the initial reaction can be the opposite. When uncertainty increases, global financial systems often move toward what is considered the safest and most liquid asset, the US dollar. Large institutions and financial systems rely heavily on dollar-based assets, especially government bonds. So in times of stress, money flows into the dollar instead of gold or silver, at least temporarily. This can cause gold and silver prices to drop or stall, even when the overall situation seems favorable for them. But this is usually a short-term reaction. Once the initial shock passes, the underlying fundamentals start to take over again. Silver, in particular, is known for its volatility. It tends to move more aggressively than gold, both up and down. This makes it more challenging, but also more rewarding for those who understand its cycles. Another key metric to watch is the gold-silver ratio. This ratio shows how many ounces of silver are needed to buy 1 ounce of gold. When the ratio is high, silver is considered undervalued compared to gold. When it is low, silver may be relatively expensive. In recent times, this ratio has moved significantly, showing that silver has started to catch up after lagging behind gold. This kind of shift often creates opportunities for investors to rebalance their positions between the two metals. But again, timing is important. Markets don't move in straight lines. Even in a strong bull trend, there are pauses, pullbacks, and periods of uncertainty. Understanding these phases is what separates long-term investors from short-term speculators. Right now, the market appears to be in one of those pause phases. It may continue for several weeks, but this does not change the bigger picture. It is simply part of the natural cycle before the next move. Looking ahead, the silver market is entering a very critical phase. The long-term trend remains strongly in favor of higher prices, but the path will not be smooth. There will be ups and downs, delays, and moments of doubt. This is normal in any major market cycle. One of the biggest risks in today's financial system is not just supply and demand, but the structure of money itself. The world is slowly moving toward a more digital financial system, where transactions are tracked, recorded, and potentially controlled. While this brings convenience, it also raises serious concerns about privacy and financial freedom. Cash, for example, is one of the last forms of truly independent transactions. When you use cash, there is no digital record, no tracking, and no external control. But as digital systems expand, the use of cash is slowly declining. In a fully digital system, every transaction can be monitored. In extreme cases, access to funds could even be restricted based on certain conditions. This idea may sound distant, but early examples have already been seen in different parts of the world. This is one of the reasons why many investors continue to value physical assets like gold and silver. These metals are not just investments. They are also a form of financial security outside the digital system. They cannot be created out of thin air, and they are not dependent on any central authority. At the same time, it is important to stay realistic. Silver is not a get-rich-quick asset. It requires patience, understanding, and a long-term perspective. Those who expect immediate results often get disappointed and leave the market too early. The real opportunity lies in understanding the bigger picture. Silver is being consumed faster than it is being produced. Physical supply is tightening over time. Demand continues to grow globally, and the financial system itself is evolving in ways that may increase the importance of tangible assets. All of these factors point toward a strong future for silver, but only for those who are willing to stay patient and disciplined. If you found this analysis helpful and want to stay ahead in the gold and silver market, make sure to follow Gold Silver Scope for more simple and powerful insights.